Hello and welcome to the Providence Investment Update for July 2026. My name is Michael Ogg and I'm joined here today by Mark Waite, Chief Investment Officer at Providence. Welcome, Mark.
Thanks, Mike.
Mark, I think I'll start off with the title of the Global Outlook and Strategy, which is After the Storm. Can you walk us through the thinking in that title?
Absolutely. So being a keen sailor, it kind of comes a little bit of a sailing analogy. And obviously the storm that we're talking about is the events in the Middle East that have been taking place since late February. And I think from an investment perspective, it's really important to take stock of what's going on in the Middle East and have a look at what the effects of that have been, but also to have a look at the broader picture. And I think the editor-in-chief of The Economist, Zanny Beddoes, she put something recently to paper and was basically saying we're in the midst of three revolutions. So the first revolution that's taking place is a geopolitical shift, and that's obviously really important. The second thing is an economic shift. And the third thing is the AI revolution. So it's really just sort of a call to really look around, see what else is happening. And then I think the second thing that I think is interesting is when we did see some peace in the Middle East in that period, sort of through June, we saw the market move pretty quickly back to an environment of looking at energy surplus as opposed to having energy scarcity. And I think that's interesting in terms of what the underlying fundamentals are for the energy market.
And just a good segue to energy. I mean, it's been a very volatile quarter. We've had energy shocks. We've had heightened geopolitical risks. And yet the market keeps on pushing higher. Yeah. Why is the market so resilient?
Well, it's really interesting, isn't it? I mean, it's really interesting the way the market's been moving. And we've been pleased to see it develop in the way in which it has. And if you look at what's happened, earnings have been quite remarkable, not just in the US, but globally. And if you have a look at the chart on the screen, you can see that we're going through a period of broadening earnings across a range of markets and a really sort of positive environment. So companies have had quite wide margins. A little bit of that is because of the sort of AI capex boom that's been going on, but it's also quite broad. If you look at the sort of earnings beats in the S&P 500, it's been a lot of breadth across different industries. The second thing is that economic growth has held up reasonably well. So there's been some good sort of supports there around monetary policy not being too tight, fiscal policy being quite good, the unemployment rate being quite low. And then the capex piece has also been helping the sort of environment. So when you actually look to markets, quite remarkable in terms of MSCI World for the year was up 21.5%. If you look to emerging markets, which has been a favourite of ours for some period of time, that was up 35.7%, with some of the markets really moving quite strongly, like Korea, which was up in the sort of triple digits. And then the domestic market struggled a little bit more. So if you look on the year, the Australian market was only up 6.11%, but a really sort of interesting environment with some solid fundamentals really sort of helping the market move forward in terms of equities.
And Mark, just on the capex boom, I mean, there's been a huge capex boom. Can you give us a sense of like how big is the capex boom and what's really driving it?
So we'll put a chart up on the screen, and that was courtesy of PIMCO, which I think is quite a good one. And it basically says the current capex boom is $14 trillion. I mean, these are enormous numbers. But I think when you sort of look at it, it is AI that's a very important part about it, but there's other elements to it as well. We talked about geopolitics earlier, and if you think about the move to reshore, that takes a lot of investment. So you're seeing the US sort of America first, production being brought on shore, Australia trying to do the same thing, other countries trying to do the same thing. The other thing is defence. If you look at what's going on in Europe, NATO is now pushing a lot of its members to start spending up towards 5% of GDP in terms of their own defence rather than relying on the US. And then the final part is really sort of fixing up the energy grid, which is kind of long overdue. So with the demands from sort of building data centres and also the electrification of the economy, there's a lot of investment going on in that particular part of the world. So a lot of things really going on, which I think are really big items that need to be monitored and understood.
And Mark, how's that capex boom flowing into the equity market and the debt markets?
It's been really interesting. Yeah. And we'll go back a little bit to AI in terms of that space. But I think what's been really interesting is we've talked for a long time about the Magnificent Seven, and they've very much been the sort of poster child stocks for the stock market since we had the boom from the end of 2022 onwards. More recently, what's been interesting is you've seen these companies which historically have been throwing off a lot of cash flow are now reinvesting quite heavily to build their data center capacity. So a lot of that cash flow is flowing from the hyperscalers, as they're called, towards the providers of the products. So these are semiconductor companies like NVIDIA, server companies like Dell, other companies like that. And you've essentially seen a lot of that money sort of move towards there. And the earnings from a lot of these product suppliers, as we like to term them, have been quite remarkable. So they've been significantly above market expectations. So you've seen that big move. The other thing that we've seen as well in the equity market is some companies that were historically seen to be quite cyclical, relatively sleepy, have actually done really well. So case in point would be someone like a GE Vernova who manufactures gas turbines. I think their waiting list is now 2031 if you want to buy a new gas turbine. And that particular stock's been up 122% over the last year. So there's been a lot of rotation in the equity market, a lot of things sort of moving around. And then the debt market's a great question. So if you think about the hyperscalers, a number of them have really pristine balance sheets. So you haven't seen too much of a move in terms of their cost of debt. But then some of the other ones that are pushing really hard, like the SpaceXs of the world, like the Oracles of the world, you've actually seen their cost of debt move up in a meaningful way, sort of above 1 percentage point compared to where it was earlier in the year. So some interesting sort of pressures there. There's a big sort of need for capital, and you've seen a little bit of a sort of upward pressure in terms of the cost of debt.
Mike, just go back to energy. Energy never really got to those sort of $200 levels for a barrel of oil. Why is that, and what's been the shock absorber here?
I mean, it's really interesting because some very, very sort of well-regarded analysts were talking about $200 oil when the events move forward. And I think people were quite worried about what that might mean for the global economy. But there's been some really interesting dynamics in the oil market. And if you think about the first thing, you had a really key member of OPEC Plus leave the cartel, and that was the United Arab Emirates. So there's obviously not going to be as much constraint on oil with that particular country outside of there. There's rumours there may be other countries leaving. The second thing is people were quite surprised about two really important pipelines that allowed the two biggest oil producers in the GCC to not have to ship a lot of oil through the Straits of Hormuz at the points in which it was shut. So the Saudi Arabia was able to pump significant amounts of oil into the Red Sea. And that was a big surprise about how much capacity they could get through those particular pipelines to their Red Sea export terminal. And then the UAE was also able to pump oil through to Fujairah. So that was a relief. The third thing that happened was you saw a number of countries either release oil from their strategic reserves, like the US, or countries that have been building strategic reserves slowing down their buying, like China, like Japan. So that had been a shock absorber. And then the fourth thing was a little bit of demand destruction, particularly in the emerging economies where you've seen sort of fuel rationing and things like that. So there's been some good shock absorbers in that place. And then I think the other thing to sort of recognise is when we did see the straits reopen, oil fell pretty quickly. It's not only sort of a month or so ago that we were hovering around $70 as opposed to in the 90s where we are today.
Yeah, I mean, good segue to inflation. And obviously oil prices flows through to everything, potentially flows through to inflation. Inflation's been reasonably benign. Can you just talk through your view on inflation?
Yeah. So it's a really interesting point in time, and there's lots of debates in the market. So there's kind of people on two sides of the debate here. There's people that are talking about we're in a persistently higher inflation environment because of all of these geopolitical dynamics, and it's going to push inflation higher. And against that, you've got other people that are saying we're in the midst for some countries of having a real productivity revolution. And you can see in a country, an open market country like the US, it's been the case for a period of time that you've seen an upward sort of move in terms of productivity, and it's moving up towards the levels that we saw in previous productivity booms for the US. So I think that's really important. You're seeing a lower share of sort of labour as a percentage of GDP. And then I think the other thing that people are thinking about is the view continues to be in the oil markets that the upward pressure on oil will be something that will cure itself over time. So if you look at the sort of December oil contract at the moment, that's negative $14. I think the bond market in terms of inflation break-evens, you and I were looking at that this morning, that's hovering in the low twos. So there's a view, I would say, that's building around productivity is coming through and that inflation is not going to get out of control like it did back in that period post-COVID.
No, right. Just changing tack slightly, some changes at the Federal Reserve. New chair, Kevin Walsh, is now in place. He's changing a few things there. And what's your view about the changes which are coming through?
I'm generally pretty positive on the changes that he's putting into place, and I think it's kind of not a bad time for looking at reform in terms of the US Federal Reserve. I think the market probably became a little bit too dependent on the forecasts, which at different points in time didn't necessarily come right. If you think about the sort of period post the COVID shutdown, there was a lot of prognostications that rates weren't going to move up again, and then we had a pretty significant rate tightening, and that caused a bit of damage in the economy. So the central bank is trying to sort of step back from forward guidance. I think the second thing is they want to have a much firmer view on how they manage the balance sheet. The third thing they want to do is look at how they're actually measuring inflation. And Walsh tends to have a little bit of a broader view on inflation, and he's obviously in that sort of hoping that productivity is going to come through camp, whilst he is really waving a big stick in terms of we need to get inflation down. He does also sort of put out that potentially we're going to move into that environment. So I think generally it's going to be quite a positive move. They're in the process at the moment of really sort of reforming the central bank. They've got 5 task forces that are addressing sort of key areas. And I think what that will do is make sure that the central bank can maybe be a bit cautious in terms of policy moves while they reform their actual process over the next sort of 6 months or so.
So, Mark, if we can try and tie this all together, how have Providence been positioned and how have portfolios fared through this whole period?
Yeah, so probably starting with the last question first. Okay. It's been a good period for portfolios. I've felt as though we've really worked together as a team to build well-diversified portfolios. We've had great resilience sort of on the downside, but we've also participated in a risk-adjusted way on the upside in terms of performance. So it's been a good year for performance for portfolios, and that's been sort of on the back of 2 previously good years for performance, which has been pleasing. And I think when we've had these shocks, the portfolios have proved to be quite resilient. And so the bits that we've really sort of benefited from have been things like, if you think about what we were talking about before, significant outperformance for international equities compared to the domestic market. That's been a very core position of ours for around about the last 4 years, where we've been overweight international equities, significantly underweight Australian equities. And then I think really importantly, as we reiterate each time we get together, the mix of international equities is important. So we've got some good exposure to the US, but we're not all in on the AI bet in the US. We've got some good diversification into emerging markets, where our manager has got some really sort of pragmatic value process in emerging markets that allowed them to participate but not be too overweight in terms of the AI trade in emerging markets. Remarkable performance from our activist Japanese equity investor. We continue to be really pleased with A, exposure to the Japanese market, and B, the way in which he's executing his activist mandate within Japan. And then the other thing is there's some interesting markets where valuations are starting to really be recognised as you've seen this broadening earnings trade, and that's really been in mid-cap global equities. So that's been good. In gold, we've been quite nimble in terms of our positioning in gold. We had been pretty significantly overweight last year. Around about 8% of the portfolio had physical gold. We took it down to 5%, and then we trimmed it pretty aggressively in that period in sort of January, February, when it was closer to sort of that up towards that sort of 5,000 type level. So that's been quite good. Credit, our managers have done a reasonable job in an environment of quite a lot of volatility. So I felt as though that's been a way in which we're sort of earning income within portfolios. And we've gently been sort of taking opportunity to increase our fixed income portfolio position from what had been a really sort of low base. And then the final bit, which we think is quite important, has been the infrastructure piece. That's been an asset class that's performed really well, both in listed and in the private space. So we feel quite good. We're very sort of always sort of looking at the risks, thinking about what might go wrong, but we feel as though the structures of the portfolio has really sort of been quite resilient in these tests. And we think for the environment that we're in, we've got some good breadth in the portfolio and some really good positive convexity in terms of the performance.
Excellent. So a really good summary. So Mark, thank you very much for your time.
That's my pleasure, Mike.
And thank you for watching. I hope you enjoyed the discussion. If you do want to hear more, would like to have any conversations around any of the themes, please don't hesitate to give us a call. And we look forward to sharing our views and thoughts in the next quarter. So until then, thank you.